Nebius Group's management team laid out the four main components of why the company believes it can be successful in the long run in the AI category. I thought it was important for those investors that are interested in Nebius Group stock to learn about these four components and understand if or why this is a reasonable strategy for success for Nebius Group. So let's take a look at this.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Nebius Group management said it's four main things that sets them apart. The first is their ability to leverage their experience in building, operating data centers, specifically with high power intensive workloads that they see across the AI landscape. And if you've been watching my videos on Microsoft, Amazon, Oracle, Meta, etc., the thing that we've been talking about a lot is these companies are spending tens of billions of dollars, some of them like Amazon over $100 billion on these data centers optimized for AI. Now, some of them are buying their own data centers and operating them themselves. Some of them are leasing data centers. They're taking on a variety of strategies with the end goal of just having that capacity, the computing capacity to run these AI models, use AI to enhance their businesses. And they are spending more than they actually can. What I mean by that is they would like to spend more than they're actually spending right now. And one of the roadblocks for these companies, one of the constraints is finding the power sources to build these data centers because they require a lot of power. And what Nebius Group here is saying is they have experience running these high power intensive workloads that's required in the AI landscape. So this is a skill that is very high in demand right now from the marketplace. So that's good to hear from an investor perspective. So they are coupling that with their expertise in developing their own hardware, and that's from servers to racks to motherboards to cooling. And cooling is one of the key things as well because these GPUs or these servers that are optimized for AI, they get really hot. And so the previous generation data centers, you were able to air cool them, and that was okay. It served your purpose. You didn't need to have liquid cooling. Nowadays, the newer data centers optimized for AI require a more sophisticated cooling strategy. And so it's good to see that Nebius Group has experience in this as well, because this is something that if you're good at this, then it can lower your power needs. Because if you're good at cooling, then you can lower the needs. You don't have to use the air cooling, which might cost more, which might require more power, versus if you can do liquid cooling or a different cooling strategy that doesn't require as much air conditioning, as much air cooling, then that can expand your options, expand your capabilities, expand the regions where you can deploy these data centers. So they couple that then with the third component, which is AI specific cloud platform that they've built from the ground up and built it in a way that is targeted and bespoke to AI workloads. And so this allows businesses to customize their AI build outs for their specific use cases. So it doesn't have to be just a generic data center optimized for AI. It can be AI that's optimized for a specific use case, which makes it more valuable for businesses if they can customize the way they need this platform to work. And the last component is the value added services. This helps them extend the economic life of their GPUs and extends a greater value well above a pure bare metal offering. And in turn, this gives them a better and enhanced way to create a return on capital invested, and also creates new revenue streams for the company that enable us to command software like margins. And that's also important because the building out of the data centers, all the hardware stuff, hardware margins are not great if you haven't already noticed. Companies that primarily sell hardware, they generate lower margins, it's more capital intensive, and so it's not as attractive as software type businesses that are able to generate higher profit margins, but it's more difficult to build these software like businesses because there's so much investment that needs to go into it up front, and then you harvest the benefits over many years if your build out is successful, if it meets the market where it wants to meet it. And so this will help Nebius Group generate higher margins, the potential for higher margins in the long run compared to some other types of data center type companies. You could think of like Dell or Supermicro Computer or Hewlett Packard Enterprises, which primarily deal with the hardware side of things, building these data centers, you know, the hardware side. They don't generate very good margins. Their operating margins, their gross profit margins are slim. Uh, they'd be lucky to generate, 12, 13% gross profit margins in their businesses. And so having this software like category, in addition to the things that they're building, allows higher margins. It also allows the company to compete better against other rivals because they can say, fine, we'll do all this hardware stuff for you at cost if you agree to also buy these software like services, these value added services, because we generate higher margins in this category. So we'll sell you this stuff at cost, just to win your business here so that we can sell you these value added services that generate higher margins that can make up for the fact that we're not really making any profit from the hardware side of things. And that's okay for many businesses. They're willing to do that because the hardware locks people into the ecosystem, and then they can sell value added services at higher margins while that customer is locked into the ecosystem that the hardware seller has created. So it's an interesting strategy here. Very early days for Nebius Group as a publicly traded company. So we're still learning about this company, and we'll see if they can execute on this strategy in the longer term. But to me, it looks like a reasonable strategy. It looks like a reasonable basis for a company to build itself. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.